My name's Nathan Fabian. It's a great pleasure to talk to you today about measuring alignment with climate goals. So, a couple of key concepts first. We need to be clear what we're aligning with when we talk about alignment with climate goals. And so at PRI, we like to think about these three layers of social and planetary thresholds. So what's going on in the real environment, the idea of sustainability performance. So what are the entities and operations and products in the economy doing, and how are they performing relative to those societal and planetary thresholds? And then the idea of ESG risks and opportunities, which of course must be located in some relationship with what's happening in the environment in society if we're to get a calibration of that risk over the long term. So it's useful to set out these three layers, we think. So let's start with the first layer. So it would be possible to say a planetary threshold around climate is around about 1.5 degrees of warming above pre-industrial levels. So this is what the scientists tell us as our interpretation of where it would be best for our natural environment and human society, human civilization, to live within warming constraints. We, of course, have an international agreement around that, the Paris Agreement, which seeks to limit warming well below 2 degrees, approaching 1.5. And then we have country and regional targets, which express this contribution to the Paris Agreement and in turn to meeting planetary thresholds. So when we're talking about alignment with climate goals, it's important to remember there are a couple of layers here, and sometimes we need to be precise about which element of this planetary boundary or planetary threshold we're contributing to. And so then we move into this question of sustainability performance, and there are a couple of dimensions here we should be clear on. And too often we are not specific about whether we're talking about a particular asset, an economic activity, a company, a sector, a portfolio of other units on this list, a country, or the globe as a whole, because they'll all have different targets, different objectives to which they should be aligned, and different metrics that you would use to try and interpret the degree of alignment. So we should always try and be clear on the units or entities we're considering. The other aspect of sustainability performance that's important to consider is, are we tracking the actual environmental performance, so the contribution to the environmental boundary or threshold, or are we considering organizational constructs, so policies, strategies, governance arrangements, targets, plans, these kinds of tools that we set up in organizations and companies especially, and within investment portfolios, to give us some indication of whether there is a path forward that can align with climate goals over time. So it's important to distinguish this actual performance from these lead indicators. And then there's this third layer around ESG risk and opportunity. Now, of course, there's many factors that can affect financial risk in markets. So momentum, reputation, whether or not a particular company is listed on an ESG index. So I'm not talking about these dimensions of financial risk. We're talking more about the longer term fundamental conditions around risk in which entities, so companies or assets, must align with the underlying trends over time. And so in this dimension, we can think about emissions costs. They might be real or they might be implied, like an estimated carbon price. And of course, we consider income from products and services and demand patterns that affect those over time. And so in this sense, the ESG risk and opportunity must again have some context that's aligned with the planetary goal or planetary threshold. And of course, the lead indicators help us here as well. If a company has a policy, a strategy, and a target that looks plausible, we can get an understanding of the future risk profile of that entity. Now, there are many frameworks in the market that are now trying to bring these dimensions together, and they each target slightly different parts of that model I just laid out. So we're familiar with TCFD, of course. People might know that investors are working on number 2 and 3, the Asset Owner Alliance and the IGCC framework. Investors also in the Climate Action 100 benchmark, but you're seeing the policymakers step in with the EU taxonomy. And some of the objectives around the taxonomy are a little different to some of the other tools on this list. And of course, we have the Science Based Targets Initiative, which itself is an attempt to try and align this target setting idea with planetary thresholds. So many different initiatives. Let's try and unpick what some of them mean in practice. I'm going to talk about 3: taxonomies, scenarios, and forecasts. So we'll look at the EU Sustainable Taxonomy, we'll look at scenarios from the IEA and the IPCC, and we'll consider the inevitable policy response forecast work that's been done by PRI, Vivid, and Energy Transition Advisors. Now, this is a very simple stylistic diagram just to show the 3 different types of tools we're talking about. So the black one with the dots is a scenario, an emissions pathway that examines what the future could look like if we're constraining for certain assumptions like levels of warming or certain technology profiles or certain policy settings. The blue one is an attempt to examine what might happen in practice considering all these different variables. If we look forward, and it's much more a traditional investor's tool to make a judgment, a forecast on all the different variables. And then we have the taxonomy, which is quite different to the other 2 in the way, because it's assessing the proportion of a portfolio or an economy that actually is performing in line with environmental goals. And so that's why that curve goes up, while the first 2 curves go down, because the first 2 curves are about emissions. The taxonomy curve is about exposure to a climate goal aligned portfolio of activities. But we'll discuss those in more detail. So first, the EU taxonomy framework. So there are 2 main alignment concepts in the taxonomy. The first is a substantial contribution to an environmental objective, the blue bubble, and then a do no significant harm idea to that same environmental objective in the grey bubble. The minimum safeguards deal primarily with social issues. I'm not going to talk about those in detail today. So the idea of substantial contribution is that an economic activity has a level of emissions, or in some cases energy intensity performance, that is considered to be consistent with realizing net zero by 2050 goal. And because many of the assets in our industrial sectors, for example, have sometimes multi-decade lifespans, the thresholds for substantial contribution are quite stringent, because there's an assumption that an asset will operate for most of its economic life, and therefore it needs to perform quite well, very low emissions levels, if it's going to be aligned with those goals for its life. Do no significant harm is a slightly different concept. It is basically a level of emissions performance which it is plain to all concerned in the market that there is either too high a level of emissions or too big a footprint for that activity to be considered environmentally friendly in any way. And those 2 concepts are carried through the taxonomy. I'll show you how they look in a bit more detail. So clearly, a zero emissions activity could be said to be aligned with climate goals, be it either the planetary threshold of 1.5, the Paris Agreement framing, or the net zero 2050 framework that many countries in the world are now adopting. So zero emissions would be considered aligned. Negative emissions technologies would also be considered aligned. Some emissions are allowable because we have a budget of emissions that we can notionally use and still get close to that 1.5 degree objective. That's where the substantial contribution threshold comes in. So if you're between 0 and substantial contribution, it's basically thought to be an acceptable level of emissions. If I go to the right-hand side, this do no significant harm threshold idea, above which, and maybe we would have coal fire generation, we'd have unabated gas energy generation, we'd have steel and cement technologies which are old and not high performing from an energy perspective. So levels of performance and emissions which it's clear are inconsistent with meeting climate goals. Then we have this area in the middle, and the European Commission has said it's going to do more work here, supported by the Platform on Sustainable Finance. The activities in between these two levels may or may not be Paris aligned, depending on what happens in the environment in practice with environmental contributors to warming and across a range of sectors. So there is a bit of a grey area where performance may or may not significantly harm or substantially contribute. But there'll be more on this in coming months. So that was how the taxonomy worked. Let's talk briefly about scenarios. Now, people are very familiar with scenarios. On this chart, I have the orange scenarios are basically consistent with IEA temperature ranges and modelling approach. And the blue and the green are temperature target consistent scenarios. So the thing about scenarios is you start with some constraint and then you model what could possibly happen with those constraints. So the temperature ones start with the temperature objective and then look at how the economy would have to develop in practice. The IEA looks at current technologies and current policy commitments in the new policy scenario and then models those out and sees what would happen. Now, the real advantage of scenarios is that they help the markets look forward. So you think about the underlying assumptions and the constraints on the models, and then be informed by the pathways in these scenarios, and then take information about what's happening in the real economy and with investments as a result of those pathways and use them as tools. So the question then becomes, what's Paris or what's climate goal aligned? Clearly something that's targeting the temperature goal, you would say is aligned because it's at that planetary threshold level. In the orange, you may say that there is an attempt to reduce emissions within this curve of this scenario, but clearly the level of warming is well above the Paris Agreement and the planetary threshold, even though it may be consistent with some short-term governmental targets. And so it may be that there is an alignment with a national target, which could be noted, but that doesn't mean that there is an alignment with the eventual Paris Agreement objective. And that really needs to be explicitly clear so we know what we're talking about in terms of alignment. So I'd like to just touch on ESG risk and opportunity. So the TCFD is maybe the best known financial risk and opportunity assessment framework that we have, and really all companies and investors should be using it to test their alignment. There's no question about that from a financial perspective. And TCFD used scenarios as a tool to help people look forward and think about the risk and opportunity. Even though it's a financial risk assessment tool, there still is this orientation between the risk assessment and the societal and planetary thresholds. If you think about it, a wild divergence in the risk assessment or the environmental performance of an asset or company from what would be required in order for the goals to be met would potentially introduce some transition risk, because there might be a divergence between a company's position and the policies that governments are increasingly starting to implement. And so even though it's an ESG risk or a financial risk-based approach, there's still this relationship to the environmental goal. And of course, the other two categories of risk in TCFD are liability and physical risks. Given that so many investors and some debt financiers think about the willingness or the capacity of an investee to make a transition, I thought I'd just comment on this lead indicators idea and distinguish it from actual environmental performance. So it's reasonable that an investor or financier would be interested in whether or not a company is willing to understand the transition pathway that may be required of them. And so you can ask all these questions. Can the company meet either taxonomy criteria or scenario requirements? Is there available technology at the right price? Do they have the right governmental policies to support their financial prosperity through that period? Is the company willing to meet the criteria? Do they have the capability? Do they have a credible plan? Is the company well governed? All these dimensions are very important to understand whether there's a willingness to align and change practice and change the balance sheet over time. Similarly on adaptation, and you can see the points on my slide to indicate whether there is a capacity to build resilience into the business and the assets. These lead indicators are essential, but they're still different to understanding the precise environmental performance. And I think this is where we start to see some of the differences between what scenarios can tell us and say what taxonomy criteria can tell us. Understanding a company's ability to answer these questions consistent with a scenario will tell us about what should happen in future. Whereas using the taxonomy criteria, it tells us what the degree of alignment is today. And so it's more of a scorecard of actual progress. I wanted to touch very quickly on forecasts, because I think we've learned through our scenario work in the investment community that just relying on a different scenario and assuming that the world will play out consistent with a scenario is really not sufficient for an investor or a company. Ultimately, a view must be taken, a judgment must be made on how the world may play out in practice. And so this is why we've done this work on the inevitable policy response. And you can see the dotted blue line, and it sits in between the 1.5 pathway and the IEA new policy scenario pathway. And so there's an attempt to judge what will happen on technology costs, how will policies change over time, what will the consumer and political sentiment be in order to make a judgment about what will happen in practice. And again, I think this is where it's important to understand that scenarios are a tool to help us look forward and make judgments. Taxonomies are a way to assess degree of alignment today and to calibrate the future plans. But these forecasts are a way to make a judgment about how a portfolio, a company, or an economy might be positioned over time, making a bit more of a granular assessment of how things will play out. And so we always encourage investors, once they've done the scenario work, is to actually take a view about how things will play out so they can understand both how far they have to take their environmental alignment and how far they have to take their financial risk analysis and risk mitigation planning or their opportunity seeking in their portfolio. And just to drive home the point on how this inevitable policy response forecast differs from a scenario, there's a judgment in there in the modelling around how policies will tighten over time, which distinguishes it from NPS of the IEA, which of course takes the current policy commitments, which we all know are insufficient to get near to that Paris Agreement. So just aligning with NPS is not an alignment with Paris, and it's certainly not an alignment with the planetary threshold. So a forecast here tries to make a judgment about how ambition would be added and whether or not it will be sufficient. And if we just go back to that former chart, you can see that even though the policy ambition is expected to increase, we don't currently see an alignment with a 1.5 degree pathway. There's going to have to be other shifts in technology or potentially demand destruction to bring that curve to be consistent with 1.5. I think most people realize that. So in conclusion, and I hope this has been a helpful overview, it's just really important to remember what we are aligning with what. And so start with that broader concept about what we're trying to achieve from an environmental perspective. Then think about the unit of measure, what entity or unit we're comparing to the performance, whose performance we're comparing to that threshold. And that's really an environmental performance layer. We can use tools like taxonomies, which assess performance. We can use assessments of governance and plans and strategies to judge future potential alignment, and it's very helpful to do that. And then, of course, we have this risk, this financial risk layer. And ultimately, we believe that if capital is well managed for the long term, that the financial risk assessment will align with these planetary thresholds through these performance expectations. And so financial risk should be informed by environmental alignment. So I hope that's a good overview and look forward to further discussion. Thank you very much.